It's me, Adriano Starianeri. I live in Panama with my wife and we like to shill high-yield ETFs that will probably clap your cheeks. Hey. Welcome back, everybody. We gotta talk about a very important ETF today. HMAX, Hamilton Canadian Financial's Yield Maximizer Covered Call ETF. 13% yield? Big banks. Now, this video was put out by Passive Income Investing, and I've covered this guy before, okay? Number one, I don't like him. He charges an insane amount of money for one-on-one consultations, and he literally has no financial qualifications, okay? I'm trying to remember what his last job was. I think he worked in, like, computer programming or something like that, but he has no knowledge whatsoever in investing, okay? I'm a certified CPA accountant. You can trust me in everything I say. This guy, what does he do? He just shills high-yield ETFs. And I'm pretty sure he gets paid by Hamilton. He gets some kind of cut for talking about their ETFs, which is fine. You know, it's a free world. As long as it's not illegal, that's fine. But we got to talk about all the ETFs that this man shills, because people confuse all the time yield with return. Yield with total return. People think that if you're getting a 13% yield, that you're just making 13%. And basically all you have to do is buy the highest yielding ETF or highest yielding stock, and you're going to make a ton of money. Well, that's not quite how it works, because return is a component of two things. It's dividend yield, actual dividend yield, not return of capital, which is fake yield. And then capital appreciation. You can have a high-yielding ETF, and the stock price can go down. For example, let's look at this ETF, and then we're going to talk about it. Let's look at the price of this ETF. So over the past month and change since it launched, this is a brand new ETF, by the way, the price has gone down 10%, okay? Even if you got 13% yield in this time frame, which you won't because it's an annualized yield, even if you got 13% in this time frame, what would your total return be, assuming the yield is actually like not return of capital? 3%, something like that? You would get a 3% return. You're not getting a 13% return, you're getting a 3% return because the stock, the ETF, whatever, went down, and your yield kind of compensated for that. But your total return is much less than 13%. Now, this could have gone down for any number of reasons. I think it's because of all the drama going on with the banking sector, okay? But you got to understand that fact. So when these passive investing, finance, income, retirement clowns, you know, they shill all these different ETFs, you got to take it all with a grain of salt, okay? Number one, what's his incentive? Why is he doing this? And number two, is this actually good for your portfolio? That's ultimately for you to decide, but you should definitely learn the facts about what you're investing in and don't get swept in by these high yields. Now, one thing I noticed that was really suspicious about this video was that he has 806 likes, right? And he has 105,000 views and only 182 comments. That's very, very interesting, okay? I would expect there to be way more likes than this for 100,000 views and way more comments than 182. Sometimes I get 182 comments, okay? And I don't get nearly these amount of views. So I'm a little suspicious. Was this paid? Was this some kind of YouTube ad? It could possibly have been 100%. But it's very suspicious to me. I just wanted to point that out. So let's go ahead and check out HMAX. What is it all about? Well, it's managed by these Hamilton people who are Canadians with their weird freaking heads. And it's Canada's highest yielding financials ETF. Notice they don't say highest performing financials ETF because it's yield. Yield does not mean return. It is a component of return. So it's got a 13.9% yield. And if we look at the asterisk there, as of February 28th, 2023, highest yielding ETF in Canada, diversified exposure to Canada's 10 largest financials with approximately 75% exposure to the big six banks. So here's my first, what? Diversified exposure 75% of this is in 6 banks. 6 banks compose 75% of, it looks like, the underlying holdings of this ETF. In my opinion, that isn't very diversified, okay? And look what happened in the United States with some of our banks that just went under. Banks can and do go under. Do I think these banks are going to go under? I have no idea. But it's entirely possible that if 1 or 2 of these banks go under, you would get wrecked, absolutely annihilated, because 75% of this portfolio, of at least the holdings, the underlying stock holdings, are in 6 banks, okay? Active covered call strategy to enhance monthly income and reduce volatility. Current coverage is approximately 50%. So a covered call is a contract where you own the underlying securities. So Hamilton buys the stunks, and then they write these contracts where they say, okay, I will collect money from you. You will pay me, Hamilton. And in return, I give you the right to be able to buy the underlying stocks in this contract at a certain price. So Hamilton's getting paid, and they're getting compensated for the risk that their stocks are going to be bought out from under them. And you are forced to give up, you are forced to sell your stocks if they are exercised. That's how Hamilton is generating this extra yield, is they're selling covered calls, okay? So it's a good fit for investors who want higher monthly income, blue chip Canadian banks financials, tax efficient distributions, I'm not sure what that means, and reduce volatility for option strategy. Now notice it says nothing about total return, okay? They say higher monthly income. I can get higher monthly income by selling VT. I could sell 10% of my stocks every month and have a 10% monthly income. I could do that. Okay, but it doesn't mean I'm getting a great return. It just means I'm getting an income. Now, it may feel good when you get that deposit. You get that monthly deposit. But if you're overall losing money or not making a lot of money, it's an illusion. It's fake, okay? Just because money comes into your bank doesn't mean that it's coming from a source, a positive source. Let's say I go to work, I tutor somebody, and I make money. Well, that's a real deposit, okay? That's like new, fresh money that's coming in. That's a positive return. If I sell an investment at a loss, or I sell an investment, that's reducing my holdings. It's a totally different scenario. Getting deposits from something like this, especially when the ETF has gone down, than making money, than actually generating a positive return elsewhere. But whatever. HMAX does not use leverage. Well, that's good, okay? Because this clown has also pumped leverage ETFs, which is not cool, okay? So here's the ticker. Here's the NAV. Here's the one-day change and the yield. Now, of course, they show the yield. Look at the yields. Look at how amazing the yield is. Big 6 average, 4.65%. You couldn't just, buy the banks and get like a sustainable yield, okay? Canadian bank covered calls, and then HMAX. How do they do it? What's the secret? Many covered call ETFs write options on 30 to 50% of portfolios. Out of the money. HMAX is able to provide higher monthly income with a dynamic covered call strategy, currently writing options on 50% of the portfolio at the money. Now, what's the difference here? Out of the money means that the stock price does not equal the exercise price of the company. When you buy a call, right? Let's say you buy a call. You want to buy the stock, you want to exercise your contract when the strike price is lower than the actual price of the stock, because you're able to buy the stock, according to your contract, cheaper. Does that make sense? So when it's out of the money, somebody that holds a call, their strike price is above the price of the stock, which means they are not likely to exercise it. What about when it's at the money? Well, at the money means that the strike price and the stock price are equivalent. So that means that the call is more likely to be exercised. You are closer to the point where somebody could consider exercising a stock. So for example, if you look at BABA options, right? This is a Chinese stock, Chinese stunk. we can see that the current price of BABA is $87.15. Now, the strike price over here is the price that you are allowed to buy the stock at. You are allowed to exercise the option and buy 100 shares of that stock at that price. Well, look what happens to the bid price. As the strike price goes down, you could buy BABA for 83. It's already in the money, right? You can exercise, you can literally buy BABA. If you bought this option, you could buy 100 shares of BABA at $83 per share. Look at the price. It goes up and up and up the more we go down and the lower the strike price is. So HMAX is basically selling options. They're on the opposite end. Well, this is selling calls. They're selling calls right around here, okay? So they're getting more premium, but there's a chance that it can get exercised because if the stock price goes up, well, guess what? It can be exercised, okay? Now, other ETFs, it looks like they're selling them out of the money. So the strike price, for example, of 91, if BABA's 87 and the strike price is 91, you're only going to get $1.03 of premium per share for a total of $103 for a full contract. You're not making as much because it's out of the money. This is who's going to exercise this? Why would you exercise this? This is saying you can buy BABA for $91 per share when it's for 87. Of course, you're not going to freaking buy it, okay? So that's what's going on here. So that's how they're able to generate higher yield. But higher yield has risks, okay? There's pluses and minuses. It isn't just like this amazing magical thing. So we keep going down, okay? Banks, here's the asset allocation. Asset, banks, insurance. So here's where I'm like, oh, I can't believe this. This is nuts. 23% of this portfolio is in the Royal Bank of Canada. 20% is in the Toronto Dominion Bank. So 44% of this is in 2 banks. That's almost half the portfolio. Oh my God. That's so I mean, like, I don't know. These banks are probably fine. I'm not saying they're about to go imminently bankrupt. I've done zero research on these banks. I'm sure they're amazing. But I'm just saying, you got 44% of your portfolio in 2 banks. Okay? And I'm not like an investing genius. But even I could see the warning signs. Like, wow, that's risky. That's pretty concentrated, right? So let's look at some of the other stuff. So, okay, we got the ticker. We know that. Assets under management. Well, first of all, inception date. This is brand new. January 20th, 2023. This just launched. You mean to tell me that you're going to just basically trust this yield that they're telling you and trust the ETF when it literally just started trading? Now, the Hamilton people can be great, okay? Maybe they're great at what they do. I'm not saying they're not. But what I am saying is this is brand freaking new. You don't know what's going to happen with this, okay? This is a whole new thing. Risky. I don't like it. Okay, so we got a monthly yield, and we got a management fee of 0.65. Very, very, very pricey. Maybe not relative to other cover call ETFs, but when you could just buy a total market index and you could just focus on total return, you could get a pretty decent management fee for like a fraction of the price of that as opposed to 0.65%. So overall, like, you know, I don't know if what this thing's going to do. This yield could easily change. You got to understand that you're investing in a very concentrated portfolio. And the reason the yield is so high is because they're selling options at the money. And that's massively reducing the upside potential. Okay? I mean, they left half the portfolio open where they, let's see, this allows HMAX to generate higher options premiums while maintaining 50% upside. So they're only writing options on 50% of the portfolio. So there is some upside potential. But at the same time, there's also the potential that if the companies go up in price, well, half of them are going to be exercised away. So this guy, once again, I don't know what he's doing. Like, is he getting paid? I don't know. This guy's sketch. I don't like this dude, okay? He's kind of a clown. Anyway, that's my thoughts. I'm not touching this thing. I don't care about yields. I care about total return. Have a wonderful day.